Welcome back. We're going to talk about earnings per share and convertible securities. And those are learning objectives 6 and 7, but I'm going to combine them into one video because they are related and we'll see how they're related shortly. So if we're talking convertible securities, what's the effect and what's a convertible security? Well, we talked about convertible bonds and we mentioned convertible preferred stock. So what does a convertible security mean? Well, we actually can convert a different security, turn it into, with a conversion option, into common stock at a preferred price. So as we said, preferred stock is one example. It makes it more desirable if you have that option. It's nice to have options as a buyer. And when preferred stock is issued, you get the initial market price by the number of shares. If there's a conversion option, the buyer will pay a premium to get that. And then you can convert one share, $1,000 bond to 50 shares, or one $50 par value share of preferred stock to X number of shares as well. So those are things you have the options that on your choice, where there's upside to roll with them. Convertible security disclosures. Tesla had bondholders get 2.375 interest, which nowadays doesn't sound like much. December 15th, they can exchange $1,000 bond for 3 shares, which when Tesla was trading close to 2,000 a share, that's a pretty darn good deal. Conversion advantages to bondholders. If they have a 327 strike price, if they go over that, it pays to convert $1,000 worth of bond. So, and then they have making that. Now the catch is there's usually date limitations. You just bought the bond, you got to wait a couple of years before you can do it. But there's limitations are okay. They can pay off. But again, it can be very desirable if the stock goes up. It also can be worthless if the stock never reaches that strike price. And then we look at the financial statements. Converting, they actually did convert some. They took the long-term debt, in this case 600,000, converted it over to shares of common stock, and the balance goes in additional paid-in capital at whatever the conversion feature rate is. So that's all there is to conversions. Again, you would not always done. They do it if it pays. So we're going to link that to earnings per share. So earnings per share is a calculation that we go through. But when you look at an income statement, there are 2 kinds of earnings per share. There's basic earnings per share and fully diluted earnings per share. So if we look at companies that say basic and diluted, compare the earnings per share. Earnings per share, it's like a stock price. If I told you, well, this stock is trading for $50 a share, and this stock is trading for $20 a share, and this stock is trading for $10 a share, which is a better company? You can't tell. Because I can buy 5 shares of the $10 stock, and I've got $50 worth of stock. I can buy 2 shares of the $25 stock, and I got $50 worth of stock. Now, if the stock goes up 10%, that's going to be $5 on the 50. It's going to be $5 on the 2 $25 shares. It's going to be $5 on the 5 $10 shares. It's the same 10%. So the stock price itself, a $1,000 stock is not necessarily better than a $100 stock. It just has a different price. Same thing for net income. If I told you a company had net income of $50,000, you'd say, that was Walmart. That's nuts. If that's a company that has $100,000 in assets, 50% ROA, that's actually pretty good. So again, the numbers themselves, unless they're being compared to something else, don't tell you much other than a rough valuation. If I said earnings per share were $1 and you told me, well, my stock costs $10, well, I know it's a 10% kind of return. If it was a $5 stock and I got $1, that's about 20%. If it's a $100 stock and I made $1, that's a 1%. So it is all relative to the other pricing in there. And the basic takes current status of what's my net income, and I need to take out preferred dividends, net income less preferred dividends. So that's preferred dividends do not count in earnings per share calculation. Then I do a weighted average common shares. If I had a stock split in the middle, or on October 1, last quarter, I'm going to have the whole number of shares last quarter and the number of shares previous quarter. I got to equalize. So we'll have some adjustments to make potentially. But the weighted average number of common shares outstanding, I take beginning, ending, divide by 2, net income minus preferred dividends. That's my basic earnings per share. Diluted earnings per share, though, will go a little bit further. We have to assume that all option holders are exercising their options. All convertible debt holders are converting their debt. If it's dilutive. If it's anti-dilutive, we don't include it. So there's some calculations the accountants get to make. And they'll go in and say, well, we assume we retired all the debt. Okay, we issued all the stock, and that's the number now higher number of shares. But the debt as retired, we're going to have to do some cash adjustments or money adjustments. We don't have to pay interest anymore, so we have interest savings associated with that. So there's some calculations the accountant gets to do. I'm not worried about fully diluted in this class. Just basic earnings per share is all I really want you to know. But I want you to be aware that diluting earnings per share is a strategic number to be aware of, and is always going to be less than your basic earnings per share. But it's something that is analyzed, examined, and part of the big picture. And again, here we have all options are exercised, and the monies we get from the options, from the exercising the options, we actually buy back shares. So we purchase shares in the open market based on the price. It may be anti-dilutive. If it doesn't dilute the price, we're going to throw it out and say we're not going to use it. But if it is dilutive, it will reduce the earnings per share as a diluted EPS versus a basic EPS. So that concludes Module 8. We're actually going to jump to Module 10, which is included this week. So I'm going to have another video for that. And then we'll go forward and look forward to catching up with you soon. Thank you for your interest, your indulgence, and your presence.